Retirement benefits are one of the most important choices you can make to help secure and protect your financial wellness. The U.S. Federal Reserve Board released a survey of consumer finances in 2013, and the results were a bit shocking. The proportion of families that didn't save from their current income was 47%. Developing the habit of putting something aside for the future falls directly in line with the financial wellness consistency model. Each situation is unique, and with a high percentage of Americans living paycheck to paycheck, you need to have a plan in place if your income were ever to be jeopardized. The American Payroll Association conducted a survey in 2014 that found 65.8% of Americans would find it very difficult or somewhat difficult if their paycheck were delayed by 1 week. 1 week. What's your plan to protect your current and future financial health? There are several vehicles you can use to save for your future and retirement. One of the most common is the 401k. This is an employer-sponsored retirement plan where your contributions are matched to a certain percentage set by the employer. Let me highlight just how important this employee benefit is. The U.S. Social Security Administration released a fact sheet in February of 2013 that found 51% of the workforce had no pension coverage, and 34% had no savings set aside specifically for retirement. One of the biggest keys to understanding your 401k is to know how your company vesting options work. Vesting, or being vested, refers to ownership of what your employer contributes to your account. There are typically two types of vesting methods used: graduated and cliff. Graduated means you would see a percentage increase over time, say 20% per year for 5 years. Cliff vesting means that you have no ownership of the employer contribution for 3 to 5 years and then become 100% vested after completing that requirement. This is important to understand when changing jobs. Because this retirement plan is through your employer, there are specific rules about borrowing from it, termination from the company, and how you are vested. When it comes to borrowing, if you take out a loan, then plan on having to pay it back with interest or a penalty. An added complication might occur if you were to leave or be terminated from the company. Usually, the retirement planning has a rule indicating the amount of time you have to repay the balance of the loan, starting from your resignation or termination. A 403b works very similar to a 401k. If you work for a non-for-profit organization, chances are you've seen references to this as your retirement plan. It has more relaxed tax rules to allow employers to make additional deposits to employee accounts. A 403b may also have more favorable vesting options for the employee. In principle, a 403b and a 401k serve a very similar purpose. Let's say you're self-employed or your job doesn't offer a retirement fund. Then an IRA or a Roth IRA can be extremely helpful. You want to understand the basic differences between the two to help you decide which one is right for you. Let's cover some key points to a traditional IRA. Traditional IRAs have tax-deferred growth. Contributions are tax-deductible and made with pre-tax dollars. There are no income limitations to open a traditional IRA account. Withdrawals prior to age 59.5 may be subject to a 10% early withdrawal penalty unless an exception applies. These exceptions include things like first-time home buying, qualified education expenses, long-term unemployment, and disability. Funding of a traditional IRA usually ends at early retirement or age 70.5. Required minimum distributions begin at age 70.5, and failure to withdraw the minimum required amount carries a 50% penalty tax on the insufficiency. Now let's see some benefits to the Roth IRA before we compare the two. Roth IRAs provide income tax deferral and possible tax-free distribution of contributions and earnings. Income limitations are imposed for single filers with $129,000 and joint filers of $191,000 adjusted gross income. There are no required minimum distributions, and you may continue to fund a Roth IRA beyond age 70.5. Qualified distributions are received entirely tax-free. Roth IRAs are funded by after-tax dollars. When deciding between which is the right fit for you, look at your adjusted gross income to see which IRA you are eligible for. Then determine which is more of a priority for your financial situation: upfront tax benefits of a traditional IRA or long-term financial flexibility of a Roth IRA. Other ways you can diversify your financial portfolio is through stocks and bonds. Given the subjective nature and volatility of these assets, we're not going to drill down in great detail, but there are a couple things to keep in mind when shopping around. Stocks signify ownership in a company, and your return on investment is directly tied to the success of the company. Bonds are known as debt investments that are for a defined period of time at a fixed interest rate. When considering either option or a mutual fund, which is a collaboration of stocks and bonds, ask yourself, how much are you willing to risk? Stocks are typically more risky than bonds, but both have the possibility of losing your initial investment. Be as conservative as possible when exploring these options. It's easier to keep a dollar in hand than to obtain a new dollar. Employee benefits can be classified under two categories: money benefits and personal benefits. Employers all across the country put together these packages to obtain the best and brightest talent for the position being offered. Ask about things like tuition reimbursement, financial planning, or employee discount programs, as these are tangible benefits that can put more dollars in your pocket by saving you money. Employers have developed personal benefits such as dependent care, employee assistance programs, or even legal aid to make their employees more content and productive. Personal benefits from work often boil down to opportunity costs. If you're considering a job change and will have to sacrifice these kinds of benefits, then there are two questions that you'll need to answer. Will your new salary cover these opportunity costs? And what are these benefits worth to you? The next video will cover a lot of great information on insurance benefits. Join us as we talk about some consumer tips to get the best coverage at the right price for things like life and disability insurance.